3 Australians retire on dividends this year. One needed $900,000. One needed $1.8 million. One needed almost nothing extra at all, because they used a trick most people have never heard of. By the end of this video, you'll know exactly which number applies to you, and the one mistake that quietly wrecks most dividend portfolios before they ever pay out a cent. Living off dividends in Australia isn't a fantasy. It's genuinely one of the most achievable versions of financial freedom on the planet, for one specific reason most other countries don't have: franking credits. When an Australian company pays you a dividend, it's already paid 30% company tax on that profit. The government hands that tax credit straight back to you. So a 4% dividend yield on the ASX 200 isn't really 4%. Once you gross it up, it's closer to 5.5%, sometimes 6%. This system dates back to 1987, introduced by the Hawke government to stop the same dollar of profit getting taxed twice. Australia and New Zealand are among the only countries on Earth still running a full system like this. In the US, the UK, most of Europe, dividend investors get hit twice. Once at the company level, once in their own pocket. Which means an ASX portfolio paying 4% can genuinely outperform a US portfolio paying the same headline number, once tax is factored in. So let's get to the number that actually matters. How much do you need to live well in Australia? ASFA, the gold standard for this research, says a single person needs around $54,000 a year for a comfortable retirement. A couple needs about $77,000. Want the lean version? $35,000 for a single. $51,000 for a couple. Want the full luxury version? Overseas trips, new car every few years, eating out whenever you want? You're looking at $100,000 or more. Here's where it gets interesting. The average ASX 200 dividend yield sits around 4% in 2026. Add franking credits, you're at roughly 5.5% grossed up. Go heavier into high-yield names and you can push towards 6% before franking, closer to 7% once it's added back in. Let's run the maths using a sensible 5.5% yield for a diversified Aussie dividend portfolio. Want $50,000 a year? You need around $910,000 invested. Want $75,000? Roughly $1.36 million. Want $100,000? About $1.82 million. Want $150,000? The genuinely luxurious life? You're looking at roughly $2.7 million. Here's what should excite you. These aren't numbers reserved for high earners or people who inherited money. An ordinary Aussie who starts early and stays consistent can absolutely hit these. But there's a catch almost everyone forgets. Tax. Even with franking credits, you still pay tax on dividend income above certain thresholds. The good news is the tax-free threshold sits at $18,200. And franking credits do a lot of heavy lifting here. If dividends are your only income, you can earn around $30,000 in fully franked dividends and pay basically zero net tax, because the franking credits wipe out the bill entirely. Now here's the part most people get completely wrong. You don't need to save $900,000 from scratch. You need to invest consistently and let compounding do the heavy lifting. $1,500 a month into a diversified Aussie share portfolio, averaging 8% total return, which is well below the long-term ASX average, gets you to $900,000 in about 19 years. Push it to $2,000 a month. You're there in 17. Start in your late 20s, and you're financially free before 50. There's a second lever almost nobody talks about, where you actually hold these investments. Dividend-paying shares inside superannuation get taxed at just 15% during accumulation, and zero in pension phase once you hit retirement age. That's why a lot of Australians targeting dividend freedom run 2 portfolios at once. One inside super for long-term tax efficiency. One outside super for income they can access before preservation age. Now here's the twist. The thing that actually wrecks most dividend portfolios before they even get started. Chasing the highest yield. If you see a stock paying 12% on the ASX, it's almost always a trap. Either the share price has collapsed because the business is in trouble, or the dividend's about to get slashed. The companies that pay reliable, growing dividends decade after decade are boring. The big banks. Wesfarmers, BHP in good years, Telstra, Woolworths, the major insurers. Not exciting, but they pay you forever, and forever is the entire goal here. You saw exactly what happens when concentration goes wrong in 2020. The big four banks slashed dividends almost overnight. People who'd built their entire retirement around CBA and Westpac alone watched their income get cut in half with zero warning. That's why you spread across 50 to 100 companies through an ETF, not a handful of stocks you like the look of. VS gives you the entire ASX 300 with a yield around 3.5 to 4%, plus franking. VHY targets higher yield names, closer to 5 to 6% before franking. There's also IOZ, INCM for monthly income, and a few others giving instant diversification with one trade. For most Australians, a simple 2 ETF portfolio will outperform 90% of stock pickers over 20 years. And you'll sleep a lot better doing it. Worth knowing how the cash actually lands, too. Most Aussie ETFs pay quarterly: January, April, July, October. Individual ASX shares typically pay twice a year, interim around February-March, final around August-September. That uneven schedule is exactly why a lot of income investors deliberately mix ETFs and direct shares, so cash lands more evenly across the calendar. Some even build what's called a dividend calendar, lining up holdings so a payment lands almost every month. Makes the jump from salary to dividend income feel a lot smoother when it actually happens. Now, inflation. The part nobody likes hearing. Need $50,000 today. In 10 years you'll need around $67,000. In 20 years, around $90,000, assuming 3% inflation. Here's why dividend investing still works long-term anyway. Quality Australian companies grow their dividends over time, usually faster than inflation. The big banks have grown dividends roughly 4 to 5% a year on average across decades. That growth is what keeps a dividend portfolio actually free over time, not just free on day one. One more tool worth knowing: the Dividend Reinvestment Plan, or DRP. While you're still building, instead of taking cash payouts, you automatically reinvest every dividend into more shares. This is where the snowball actually starts. Your shares pay dividends. Those dividends buy more shares. Those new shares pay more dividends. By the time you flip the switch from accumulating to living off the income, your portfolio is producing dramatically more than it would have if you'd been spending along the way. So here's the full picture. To live off dividends forever in Australia, you're realistically looking at somewhere between $900,000 and $1.8 million, depending on the lifestyle you actually want. You get there by investing consistently into quality Aussie dividend stocks and ETFs, leveraging franking credits to slash your tax bill, avoiding high yield traps, and giving compounding the runway it actually needs. So which of the three Australians from the start of this video are you? The one who needed $900,000? The one who needed $1.8 million? Or the one still chasing a 12% yield trap, wondering why their income keeps getting cut? If this gave you a real number to work toward instead of just a vague dream, hit the like button. If you're not subscribed yet, now's the time. And turn on notifications so you don't miss the next one. I'll see you there.